Hello everyone, this video is on my favorite strategy, selling puts. I apologize in advance if there are any audio issues. I'm currently traveling and recording this from my hotel. Selling puts is my main strategy. I would say it makes up probably 95% of the trades that I do. And the reason that I love selling puts is because I'm horrible at picking direction. And so even though selling puts is a bullish strategy, even when I'm wrong in my direction, I can still profit when the stock doesn't move or even if the stock drops a little. And in instances where the stock does drop to where it drops below my strike price, there are still adjustments I can make to still come out without losing money. I would say that I rarely lose money on selling puts. Not to be confused with that I'm never wrong. I'm wrong all the time. It's just that when I am wrong, I make adjustments to the trade to where I can hold on to that position and wait for it to recover so that I don't take a loss. And I'll show you how I go about doing that. If you take a look at my trades from last year, I just took an export from my brokerage account for 2017. I did a ton of trading last year. I did over 700 trades, and if we look at the second column here that shows the type of trade, anywhere you see short sell is basically I sold a put. Like this was a put on American Airlines at the 46.50 strike. If you scroll down through, you can see all of these say pretty much short sell. And I would say out of all these trades I did, I could probably count on one hand how many of them I actually took a loss on. Because again, I always stick with the trade until it recovers. If we look at I put together a graph that shows my percent return. Where'd it go? There it is. My percent return for last year. So that's on a weekly basis. So at the bottom, it's 52 weeks. And so you can see, I finished the year above 200%. Anywhere you see these big dips, these are not losses that I took. These are situations where I'm having to hold on to positions, as I mentioned earlier, that I'm down on and having to wait for them to recover. So typically when I sell a put, I'm selling it for just a week at a time. And best case scenario for me is when I sell the put, I receive the credit, and then a week later, the option expires worthless. I keep the credit, and then I move on to another stock. And I do this week after week, and I'm generating that weekly income. And I try to spread my money across multiple stocks at once and not just put all my eggs in one basket. I want to spread my account across multiple positions so that if there is one position that goes bad that I'm having to hold on to, I still have those other 4 positions that I can close out of and then use that money to get into other trades for another week and still make a weekly income. But if there's situations where the market drops and I'm having to hold multiple positions longer than a week, then that just means those are weeks that I can't sell puts to make income, and that's when my account will start dropping because my account balance is dropping because of those stocks dropping. But these are not realized losses because I'm never closing these out and taking the loss. I'm holding on to them and I'm rolling them for duration. I'm actually pushing them out to the next expiration cycle, waiting for them to come back up. And sometimes I may have to do this week after week after week. I may have to roll these for months at a time before the stock finally recovers, but I never take a realized loss. And I'll show you later how that's done. So that's what these dips represent. And then once the stocks recover, that's when I can start making money again to grow my account. So that's what these little blips are. You'll see your flat areas. Those are weeks that I for whatever reason could not place any new trades. The only dip that is not the case is this dip here at the very beginning, because I know exactly what that dip is. That sharp dip from week 4 to 5. I had grown my account to 40% pretty quickly, and then made the dumb decision that I was going to take the entire profit that I was up and put it into an Amazon earnings trade to gamble on earnings, that they were going to beat earnings. Everyone has that one stock that is their Achilles heel, and Amazon is that stock for me. It seems like every time I trade it, I always lose on that stock, regardless of the strategy that I choose. And this was another case of me making, a dumb decision trading it. But anyway, I put my entire profit in, and the trade went sour, and I lost that profit to where basically my account went back to my starting balance of the year. But luckily, I was able to grow that back significantly, above 200% for the year, because I stopped doing those stupid trades like that. And I don't want to, get the false impression that this is something that you can accomplish every single year. I mean, last year was a very unique year in that we had a very strong bull market. It was pretty much a straight up market last year in 2017, except for some minor dips that recovered very quickly. And so since selling puts is a very bullish strategy, obviously when you're in a strong bull market, this strategy works great. And my target is typically to make 2 to 5% a week, and so that's what allowed me to grow my account so much last year. This year, on the other hand, has been a harder market to trade because we've had a lot of ups and downs, we've had a lot of volatility, we've had a ton of news has come out that made the market take some dips, like with the tariffs and things like that. So it's been harder to sell puts because I'm having to hold positions a lot longer than I typically had to last year, waiting for the stocks to recover. And as I mentioned before, when I'm holding stocks like that, I'm unable to sell new positions to generate weekly income. So I'm still up this year. I don't have a graph to show you because I haven't plugged those numbers into Excel yet, but I'm up about 15% this year, which again isn't bad. I mean, it's not where I was this time last year. I think this time last year, we're probably in week 19 or 20 right now. I was up 60%. Now I'm only up 15%. But that's not bad when you compare it to where the market's at. The S&P 500 is barely even up this year. It's not even up a full percentage point. So I'm more than beating the current market. And then hopefully, if this year we can have somewhat of a bullish market, I expect my account to grow a good bit more. So, again, not wanting to set the expectations that this is what you can accomplish every year, but I feel like, this is the strategy that all of us should strive to move towards. Everyone has their own way of trading. Some people prefer day trading. Some people prefer swing trading. And I think that's great, but I think at some point everyone needs to put this strategy into the mix, even if it's a small percentage. Because for me, at least, this is the strategy that I can rely on to give me that weekly income. And then I can take those weekly profits and maybe put them into other strategies that are riskier, like if I want to buy a call spread to play earnings, or if I want to buy, do some day trades, or I want to do a riskier, trade by buying out of the money cheap options. I can finance those trades with the money I'm making on a weekly basis from these puts, as opposed to spending my own money and potentially, losing my original capital. So that's why in that earlier example I showed you with Amazon, I was willing to make that stupid gamble using all my profits, because I was, again, just using my profits that I had made in those first few weeks of the year selling puts. It wasn't like I was risking my original capital by doing so. So just keep that in mind, that and even if your account is not at a level yet that you can sell puts, because selling puts is a little more capital intensive, that you need more cash to be able to do this strategy, especially if you don't trade a margin, because if you trade a cash account, it requires you to have the full amount of cash sitting in your account to if you were to have to get assigned stock. So don't get discouraged if you feel like you don't have the amount of cash in your account to do this strategy. My suggestion is paper trade it until you do. I have a good friend who I've been teaching to trade over the last several months, who knew nothing about trading even stocks, true beginner when it comes to the stock market. And he's been selling puts in a Thinkorswim paper account and he's doing awesome. I mean, now he's got the strategy down pat, and he's making really good returns to where, he's excited about the fact that one day when he is able to save up enough money that he can actually start doing this strategy in a live account. Whenever that time comes, he's now, on a path to where he's perfected it already. So I would make that same suggestion to you as well, that, if you don't have the money now, while you're doing other types of strategies and you're saving up money to get to the point where you can sell puts, I would paper trade this as frequently as you can and learn all the nuances about it, and get a feel for, how the options move and how it affects your buying power, and how to roll the trades for, when trades go against you. All the things I'm going to show you here in a second. Definitely something you want to practice and get really good at before you, even if you do have the money now to do this, you want to paper trade this for a few months to make sure you got a handle on it, because it can be tricky jumping into this without making sure that you've got a good handle on it. So let's really quickly look at what what selling puts is all about. Most people should know what a put is, and specifically what a put is from a buyer's perspective, because that's what most people are doing right now is buying puts. And there's two main reasons why someone would buy a put. The first reason is not one that we typically think about, because not most traders like ourselves are using puts for this reason, but there are people out there who use puts to buy insurance, to protect stock they own. So if someone has 100 shares of stock and they're afraid the stock could drop, they can buy a put that allows them to protect the stock at a certain price, so that, let's say they bought the stock at 100, they could protect it at 90, so that if the stock dropped to zero, they can still get $90 for their stock, and they won't lose the full amount. It's no different than if you have car insurance. When you buy a car, you also buy insurance on your car to protect it in the case there's any damage, or if there's an accident, that you can be made whole again and get the full value of your car back if something is to happen to it. And to do so, you have to pay a premium for that. So with stocks, it's no different. When someone buys a put for the intent of protecting their stock, they're buying it to make themselves whole again if the stock drops, that they can get reimbursed essentially for the original value that their stock was worth. And of course, they have to pay a premium for that, no different than how you pay a premium when you buy car insurance. The second reason why someone buys a put, which is the reason that most of us buy puts, is for speculation. We're just placing a bet that the stock is going to go down. We have no intent of protecting a stock because we don't own any shares of that stock. We're trying to profit off the fact that we know that an option's value will increase when the stock decreases for a put. And that's the only reason why we're doing it. It's basically just a bet the stock is going to go down. So those are the two reasons why someone would buy a put. Well, when you buy a put, there's obviously somebody on the other end who's selling you that put, and that's the side of the trade that we want to look at taking. So if we're selling a put to the example for number one, a person buying insurance, we become the insurance company. We become no different than the insurance company who is selling you the car insurance. That insurance company is taking on the risk on your behalf. They're willing to, cover any damages that you get on that car, and in return, they expect you to pay them a premium to take on that risk. And insurance companies, they look at all the statistics and probabilities to know what the risk is going to be based on your age and what car you're driving and your driving history, and they factor in all those things when it comes to determining what your premium is going to be and whether or not they want to take on that risk. And they also spread their risk across multiple car owners. They're not just insuring one person. That's risky, because that one person could get in multiple accidents, and that car insurer is going to have to pay out a lot more fixing the car than they're going to receive in premiums. But when they spread that risk out across hundreds of thousands of car owners, they know statistically it's going to be a very small percentage of those car owners that are going to get in an accident that they're going to have to pay out to fix those vehicles. And with everybody else, they're going to just keep receiving that premium every month. And that premium they receive is going to be well more than the cost they're going to have to spend to fix that small percentage of people who get in accidents. So it's the same thing when you sell insurance as a put. When you sell that insurance to that put buyer, you're taking on the risk on their behalf, and in doing so, you're going to get paid for that premium. And you want to spread your risk across multiple stocks. You don't want to just insure one, because what if that one stock moves against you? You want to spread that risk across multiple positions so that you may have one stock that's going against you, but there's four that are doing well that you're collecting that premium off of, and that you can just keep. In my case, I do it weekly, so week after week, you're just collecting that premium and never having to worry about paying any money to so-called make that put buyer be whole again, because of their stock dropping. If their stock never drops, then you never have to fulfill your obligation. It's only when the stock drops below your strike, then you have to look at possibly buying the stock or taking a loss. But if you spread that risk across multiple stocks, you're not, you're making the premium on some stocks enough to offset any losses that you're making on the stocks that go bad. And then when you look at selling puts from the second example, if you're selling put to a speculator, then basically you're just becoming a bookie, like a sports bookie. You're taking bets, and you're taking that bet because you don't feel like the stock is going to drop to the level that they're wanting to take a bet on. You look at the statistics and probabilities, and we'll see here in a second how you look at that to where you feel like the risk is worth taking that speculative bet so that you get paid that premium and never have to do anything else. You get paid the premium, and then the option expires worthless, and you move on to the next stock. The people who go buy those really cheap out of the money options, that only have about a 15 or 20% chance of making any money, those are the people we're selling to. It's like free money in a way. They're willing to pay us for those really cheap options that we know are going to expire worthless for the most part. Those are the people that we're selling these cheap options to. And at the end of the day, we don't really care who's on the other side of that trade, whether it's somebody who's buying it for insurance or whether it's somebody who's making a speculative bet. We don't really know their intent. We don't know if they own shares or not, or what their reasoning behind it is, and we don't care why. I'm just giving you examples of what their motives, what a motive would be for someone buying a put. But as a seller, our only goal is to collect the premium. We don't really care. Ideally, we'd want the stock to go up, but whether it goes up, stays the same, or even down a little bit, we just want to collect the premium and hope the stock stays above our strike price so that it expires worthless, and then we can reallocate our money to the next trades for the upcoming week. And then here at the bottom, I just wrote that a put buyer, they have the right to sell shares of stock, and then as the put seller, we're obligated to buy the shares of the stock. So, whoever's buying that put from us, they can force us to buy their shares at any given time. Typically, they will wait until expiration day to do that, but they can actually do it early. It's called early assignment, and I'll show you some examples of that. But so just know that anytime you sell a put, you are obligated to buy their shares if they decide to. Now, they're not going to make you buy shares if the stock didn't drop below the strike price, but once it drops below the strike price, they can force you to buy that stock at any time. And again, they're going to have to pay you a debit. They're going to pay a premium to do that, and you're the one who receives that premium. You get a credit for taking on that risk of potentially having to buy their stock. So let's look at how I would actually execute this strategy. I have up Micron Technologies just as an example. I'm not necessarily advocating selling a put on this one. It's a stock that I trade a lot, and just going to use it as an example. So when I'm trying to define stocks to sell puts on, I typically will just go through my watch list. I have a watch list of probably 50 stocks. I will look at, try to find 5 or 10 stocks. I like to have 5 or 10 positions on at a time, and I'll divide my money up equally across those positions. Again, so that I'm not putting, I'm not selling puts on all, selling insurance on just one stock. And once I, go through and find the stocks that I want to trade, I may look at a chart just to get a feel for some basic support and resistance. I don't do any kind of crazy technical analysis. I may just want to get a feel for, what levels I think the stock could trade at. And, if I feel like the stock is roughly in a neutral to bullish pattern, that's a good candidate for selling puts. But the main thing that I'm looking for when I go to choose my strikes is I'm looking at this probability of out of the money. As I mentioned with insurance companies, they're looking at the statistics and the probabilities of what's the likelihood of you getting into an accident. This is no different. We want to look at what's the likelihood of the stock getting into an accident. And this is what these probabilities tell us. These probabilities tell us what is the likelihood of this stock dropping to these particular strike prices. I like to focus on in between the 70 and 80% range when I'm picking my strikes, closer to the 80% most of the time, because the 80% probability puts you roughly outside of the expected move. You can see right now the expected move is 2.94 next week for Micron Technologies. That would put the stock right around 48. And we can see the 48 strike price is right at 80% probability of out of the money. So any stock you look at, if you automatically go to the 80% probability of out of the money, that's going to roughly get you at the expected move. So, if it's expected to move 3 points next week, then we would want our strike price to be below that, because we don't want it to, go below our strike price. So this is kind of the area I would start in. And again, what these percentages mean, this is your percentage of success, in the sense that it's an 80% chance that it will not go to the strike price, which is, again, what we want. We want the strike price to be out of the money. So that's why this is called probability of OTM, probability of out of the money, the statistical chance that this strike price will be out of the money at expiration. And that's our goal. So sometimes I will come further in on my strikes. If I'm very bullish on the stock, maybe I'm willing to get a little riskier and come in at the 70% level, especially realizing that if I am wrong and the stock does drop below my strike price, I know there's ways that I can fix it and again, hold on to it until the stock recovers. So those are things I factor into when I'm selecting my strike prices. But let's just take a look at the 48.50. That's a little bit inside the expected move, but the fact that we're receiving a 50-cent credit for this one, 49-cent credit, that'll put our break even right around 48, which is the expected move. So that's not bad. If it goes the expected move, worst case, we'll break even on it. So I would start here, and I would click on the bid since we're selling. And this brings up my order window at the bottom. I'm going to change this to one contract. And we're doing the 48.50 strike. We're going to get paid 49 cents. If I hit confirm, you can see our max profit is $49. My buying power effect, which is the amount of money I have to put up to place this trade, is $746. Now I'm trading on margin. On margin, my broker only requires me to put up 20% of the value of the stock. On a cash account, you'd have to put up a lot more money, which makes it hard to sell puts if you have just a cash account. Because on a cash account, you'd be required to put up the full value of the stock if it got assigned to you. Since our strike price is 48.5, that would be equivalent to $4,850 worth of stock. So on a cash account, you would need $4,850 in your account that you can set aside to cover in the event you get assigned shares. Where for me, I only need $746 set aside in the event I get assigned stock. So it's a huge difference because, if you only have $5,000 in your account, in a cash account, you're having to pretty much tie up all your money that's in your account for this one trade to make $48. Whereas in my case, if I had a $5,000 account, I'm only using $746 of that to tied up, and then I have a little over $4,000 to allocate to other trades, to where maybe I could have on 5 or 6 trades at once with that $5,000. And then also it makes your percent return greater as well. If we look at, you may think, wow, that's not very much money to receive a credit based on how much I'm having to put up, $48, and I'm having to put up $746. Well, if we look at, let's see, calculator here. So if we take 48 divided by 746, it's a 6% return. So I mean, that's a really good percent return in 1 week. If you could replicate that every single week, what's going on here? If you could replicate this every single week, that's over a 300% return you'd make in a year. So this is a really good return, but again, this is because I'm only having to put up 746. If I had a cash account and had to put up the full amount, that'd be $48 divided by 4,850. So not even a full percentage, almost 1%. So the leverage you can get on margin, makes your percent return a lot greater in a given week. So that's something to keep in mind too. Margin can be a double-edged sword. You never want to use all your margin up, because again, if you do get assigned stock, you're potentially having to buy more stock than you have cash in your account, which is not a bad thing either. I had that happen to me on occasion, where I get early assigned and am having to buy stock more than I have in my account, and I'll show an example of that here in a second. But this is just the basics of how you would put on this trade, and ideally you want the stock to stay above your strike price so that it expires worthless, and then that once it expires, it will free up that money that you had to set aside, so then you can reallocate that money into a new trade. Whereas if the stock goes against you and you have to stay with the trade for a longer period of time, well, that money is going to be tied up, for maybe several weeks or even months, depending on how long you have to hold on to it, waiting for it to recover. So those are periods where you would not be able to utilize that money for other trades, and so that will reduce the amount of money you're making on a given week. And also you can see the max loss here is 4,800. Max loss is only hit when the stock goes to zero. So I mean, the chances of Micron Technologies going to zero next week is pretty much impossible. So you're not truly risking this $4,800. You're not even really risking the 746. That's just the collateral you're setting aside in the event you have to buy stock. Because if it drops, you still will have the stock that you can hold on to and wait for it to recover. The only way that you would eventually lose money is if the stock continued to drop and eventually went to zero or went below the amount of cash you had in your account to hold on to the stock, to where you'd have to sell the stock for a loss. So let's look at an example of a trade that went against me and I had to hold on to it for a significant amount of time. This is Las Vegas Sands. Actually, I need to come here. Las Vegas Sands. Oh. So you can see I put this trade on March 8th. I sold a total of 8 contracts. It didn't fill them all at once, so it filled 2, then 3, and then another 3. So 8 in total. I sold the 77 strike, and I received a $1.89 credit. The credit's high because at the time I was a little risky on the strike selection. I think I'd only had maybe a 60% chance of success, but I was very bullish on the stock at the time and decided to get my strikes a lot closer. And of course I was wrong and the stock dropped. If we look, I got in, I think on this green candle here, and then of course the stock dropped off. My strike price is up here at 77. But you can see, I held on to it this whole time, and it eventually recovered to where now it's above my strike this week, to where I don't have to hold on to this anymore. Come Friday, assuming it stays above 77, it's at 77.89 right now, I'll be out of this trade this Friday, which will free up my margin, my buying power that I can now utilize for a new trade for next week that I haven't been able to do for several weeks now because I've been holding on to this one. So what happens when the stock moves against me? What I do is, it's called rolling. And I'll show how to actually execute the roll, but I'll just talk through the different trades that I had to perform. So when I put this trade on the 8th, I received a $1.89 credit. And on the 13th, I rolled it. And here are the two trades that I rolled, because again, it did 6 contracts and then 2 contracts. But when you roll, what you're doing is you're closing out your current position. So my initial position was the March 16th expiration. You can see here, here's a close order to close out that March 16th position. But simultaneously, I'm opening a new trade, and I'm getting into the exact same strike price for the following week on March 23rd. And this gets executed as one trade. And when this trade was executed, I received another credit of 88 cents. So what the cool thing about this is I'm getting paid to stay in the trade. Even though the trade is down, the stock is below my strike price. I'm at technically I'm losing money, even though it's not a realized loss. I get paid to stick with it for another week. So someone's paying me another 88 cents to stay with this trade for another week. And then you can see on the 16th I had to do it again. So I closed out my previous week of the 23rd. I'm now putting it on the 29th, and I got paid 15 cents. It was less this time, probably because again the further the stock drops, the less credit you're going to get for rolling. You can see I keep continuing to do this week after week. I had to go to April 6th, April 20th, week after week. I keep rolling. My credit gets less and less because the stock is continuing to drop during this time period. But it's fine because I'm still getting paid money to stick with it. I'm not losing money every time I roll these positions. If we come down to February 3rd, you can see all of a sudden I had a stock sell. And the reason for that is I got early assigned, because expiration was on May the 4th, but someone early assigned me stock unexpectedly. I wasn't expecting that to happen on March 3rd. Let me find here's the email. You can see up top it was on Thursday, March 3rd. I got an email that morning saying that I was assigned LVS stock at the 77 put. You can see it even goes on to say, note that your balance and positions may not be updated until the following business day. Please be aware that option assignment may cause insufficient balances or short positions that cannot be maintained. So this is what happened in my case. I didn't have the cash in my account to cover buying a stock at $77. So when it says insufficient balance, that applied to me. So I wake up that morning and I've got a negative balance in my account, which can be scary at first, but it's actually not a big deal, and it's something that can be fixed easily. And my broker gives you, I think it's 5, maybe even 7 days to resolve a negative balance, whether it be by depositing more cash in your account, which I didn't have the cash to do, or by fixing the trade, by selling off other positions in your account to free up some cash. Or in this case, what I did is I was forced to buy 800 shares of this stock at 77. Because that's the strike price that I was trading. that day around noon, I just sold my shares at the current market price. And I didn't really care what the price was. I'm selling it for a loss because I paid 77 to get in it, and I'm selling it for 75.07. So I'm taking about a $2 loss by selling it. The reason I don't care is because immediately after that, you can see 1 minute later, I sell back into that put again. And it looks like I accidentally sold more contracts than I sold 9 contracts in total instead of 8. That was probably just an error on my part on the contract size, but that doesn't really matter. But you can see when I sold this, I got paid $2.13. So this allowed me to recover all the losses that I made from the stock sale. I'm losing not even quite $2 again because I bought it at 77 and sold for 75.07, but yet I'm making $2.13 when I sold this put. So this basically recovers all my losses plus makes me a little bit of extra money, and I'm right back to where I started again. It's almost as if the early assignment never happened because I'm getting out of the stock and putting myself right back into the exact same trade that I was in before, except I'm doing it for a different week. I was in the May 4th, and I went ahead and pushed myself out to the May 11th expiration week. And by doing so, my account was no longer in the red. Again, it basically just put me right back to where I was as if the early assignment never happened. And now, since the stock has gone up above 77, I won't have to roll this anymore. I should be able, this option will go to zero. If we look at it right now, for this week, the option is worth, right now it's worth 23 cents. So actually tomorrow I can close this out for 23 cents, and I may go ahead and do that. Instead of holding until Friday and waiting for it to go to zero and risking the stock possibly dropping back below 77, I might just go ahead and close this out for 23 cents and be done with it. But if we consider the fact all these credits that I received every single week, if we add all that up in Excel, and I've already got it here, this is every single credit I received week after week. My total credit received was $3.69. So for one contract, that would have been $369. My margin requirement, I can't see what it was when I initially put it on, but I know it was roughly around $1,400 a contract. That would have been a 26% return over this time period. If we broke it up to weekly, it's about a 3% return a week because this was over a 9-week period. This trade lasted me from March 8th till this week. May 11th is when I'm going to get out of it. So over a 9-week period, I made 26%. That's 3% a week, which is great. That falls right in line with what I try to make on a weekly basis. It's just that I had to hold on to this trade longer than I would have liked. Ideally, I would have been in it for 1 week, but I had to tie up my margin for 9 weeks to hold on to this trade so that I wouldn't have to take a loss. I could have closed this out at any point in time, but by doing so, I would have taken a loss, or I would have been assigned shares if I didn't close it out. So that's the great thing about rolling, is because as I said before, I rarely take a loss with this strategy because I'm always sticking with it, even if it means having to roll for 6 months straight for this, waiting for the stock to recover. I keep doing it so that I never have to take a realized loss. Lastly, I want to show you one other trade, just to show you how I would actually execute a roll. Twitter. Here's another one that I've traded a lot this year. You can see all the credits I've received. 30 cents, 5 cents. I closed it out for 19 cents. I got another credit for 83, and I closed it out for a penny. I got 62 cents here and closed it out for 6 cents. Here's where I got in for 50, and I had to do several rolls. And right now I'm going to have to roll it again because my strike price is at 34, and the stock is trading a little above 32 right now. So I'm going to have to, come Friday, have to roll this unless the stock goes up to 34. So the way I would do it, and I use my mobile app to trade, so I just took a screenshot to show how I would do this in the mobile app. So the stock is at 32.46. My current strike price is 34. So, I can close it out right now and take a loss. I can close it out for 152 and I would take a loss. But I don't want to take that loss, so I'm going to roll it. At the bottom of that screen, there is a section called Create Rolling Order. So I will click on that. And when I do, it brings up two entries. This first entry is closing out my current week, which is the week of May 11th. It's going to buy those options back since I sold them originally. And then it's going to open a new trade for the following week expiration and sell the same number of contracts at the same exact strike price. So essentially all I'm doing is staying the exact same trade, but I'm just extending myself 1 week. So this keeps me from getting assigned stock, because if I let it expire Friday, I would end up getting assigned stock at 34. So by rolling it, I don't get assigned stock, and it keeps me in the trade, and I'm going to get paid another 29 cents to do this. I'm going to get paid $270 to roll it and stay in this for another week. And the next week, hopefully it comes back above 34. If it doesn't, then I just keep rolling it, and I keep doing this week after week until finally the stock comes back. So this is what I do every single week. I could show several other trades. One more MU. Look at how much I've traded this one this year. MU's been really good because if you look at a chart, this whole entire move up here, even the sideways move is great because I can just pick a strike price, and as long as it stays sideways, I'm still making that premium. And as it started going up, I just kept following it up, selling puts all the way up. So you can see I'm getting 75-cent credit, 65-cent credit, $1.06 credit, and then when I close these out, I'm closing them for cheaper than what my initial credit. And I had to roll it a few times, but for the most part, a lot of these it expired worthless to where I got to keep the full premium or only bought it back for a few pennies. So hopefully that gives you a good overview of what selling puts is about, how you can fix the trade when it moves against you. If you have any questions, just let me know. Thanks.